If you've been struggling to find a trading plan to stick to and you want a mechanical and profitable trading system, look no further. In this video, I'll reveal a step-by-step trading plan with a checklist and lots of details. If your psychology and risk management are on point, then there is no reason you won't be a profitable trader. Make sure you stick till the end, as I'll give you access to a PDF that has the trading plan steps and all details needed. This is Mulham Trading, and let's get started. Okay, instead of going straight to the trading plan, it's going to be so confusing to cover all points at once. So what I'm going to do is break it into 4 main points. The first one is going to be how to determine our high probability point of interest, and then our liquidity too. So basically, let's say price was going this way. Instead of coming and going this way, I would go and I'll mark any order blocks I have or fair value gaps without looking at anything else. So let's say there's a fair value gap here, fair value gap here, and then I'll be marking all of them. Instead of this, what I'll do is I'll go and mark my liquidity. Let's say I have some liquidity here, then the same thing here, and then anywhere else. Let's assume there's a liquidity here. So first, I start by marking the liquidity, and then after that, I'll be looking for point of interest either below or above the liquidity. Okay, it depends on the direction. In this case, since it's bullish, then I'll be looking for point of interest just below. If there is this type, when I have a fair value gap here, and then I have a liquidity or a swing low that did not go below the fair value gap, then this would be my high probability point of interest. Also, there's another case is when we have price going, let's go here. When price is going up, then let's say I have a point of interest here. Okay, let's say a fair value gap, and it barely goes below and then immediately start going up. It doesn't show the momentum that we want to see. Then mostly this is still the unfilled part of this fair value gap. If it doesn't go below the 50% of this part, mostly it's going to be a high probability point of interest. And also it's going to be a high probability liquidity sweep in here. So most likely what's going to happen is price will come, give a liquidity sweep here, and price will react from here inside this higher time frame point of interest. So basically, in order to mark a high probability point of interest and a high probability liquidity sweep, we need to see a liquidity above or below a point of interest, and we want to see the price sweeping liquidity into that higher time frame point of interest. Before continuing to the video, if you want to take your trading to the next level, then you need to backtest your strategy and make sure it's profitable over time, as well as testing and backtesting other strategies to see which one fits you the best. I personally use Trader Edge, which is one of the most efficient tools available in the market. You can backtest your strategy 3 times faster than traditional spreadsheets, and it's going to show you all the statistics of the strategy immediately. Make sure you use the link in the description to get access to the platform. So let's take some examples in here, okay? So I have this fair value gap here, and I do have this swing high here. Price come down, but then it can't go up anymore. And I could see the weakness happening here. What I was expecting from here, and this I shared it everywhere, I marked this as my liquidity. And this is the unfilled fair value gap here. What happened is price goes up, take a liquidity inside this unfilled fair value gap and started to go down. This happened most of the time. And if I look to the left here, what I saw here is, see this fair value gap, there's unfilled part of this fair value gap, and there is a liquidity here. What happened is price sweep the liquidity to fill this fair value gap and then started to go up. You could find a trade here. If I come here, for example, similarly here, there is this liquidity here, but then there is unfilled part of that. Especially maybe in the daily, there is a order block here, a clear one. What happened is price come down with wicks, took this liquidity, and then react from the order block here and started to go up. It always happened. It always happened. This can also happen on the weekly, on the monthly, the daily, and the 4 hour. If I mark here, I had this fair value gap here. Okay, this one. This was my fair value gap. Price come here slightly below the fair value gap or inside the fair value gap and started to go down. Most likely, this would be a liquidity in the future. That's how I see it. So what I do is I take the unfilled part of the fair value gap all the way until here. What I was expecting is price to come here above this liquidity zone here into the fair value gap and it started to go down. And that's what happened. You can see a liquidity sweep here inside the fair value gap and started to go down. This is similar as taking a fuel. You see how price started to get tired and you see some weakness. Price started to go up and then take some fuel from here and will start to go down again. Now, after we learned how to determine and mark out high probability POIs, what we can cover now is what happened after a liquidity sweep. We'll cover what's happening here, okay? So we're going to cover the candle formation and the entries based on those candle formation. Okay, so the first candle formation, and this is something that I could develop myself, and it's something that I use. I do use some other stuff that maybe I'll make another video about, or I'll just keep it to myself. But for now, basically, let's assume the sweep happened here. We go to a lower time frame, and I'll cover all the time frames later. Let's focus on this. So the sweep here, this is the, let's say, the old high. Let's come down. This is my liquidity level now. What I want to see in the lower time frame is a candle not closing above. I want to see a big wick. That's what I want to see. And also in the swing high, I also want to see the wick clear. Okay, so I want to see a wick to a wick sweep. And after that, the next candle, let's assume it opens here. I want to see two candles with the same body level. I don't want to see the body of this candle higher than this one. And I want to see a smaller wick. So basically, I don't want price to close above this level, even in the lower time frame. I don't want to see it sticking around here. I want to see a big reaction after. I want to see a bigger wick to the left, a smaller wick to the right. This creates, see this pattern here. This is the rejection block, especially with the bigger wicks. This is a rejection block. This would be your shield. Even if you have your stop loss above and you enter based on our entries later, it's going to be like a shield. This is your line of defense. Now, when price closes below the 50% of this candle here, and prices closes below the 50%, then you would know that you're more bearish. So it's an indication that price is turning bearish again, which also confirm that this is a valid liquidity sweep. In this case, what we can do is wait for a price to go down. Any fair value gap available to enter, you would enter from, and then you will target liquidity. Okay, so in this case, no need to wait for a change of character or market structure shift. No need at all. We can enter from a fair value gap directly. Now, there's another case when we have, say, our sweep here. This is my old high. And you guys don't forget that I do have a PDF for you. Just stick to the end to know how to access this. It's going to be a high quality details and high quality visuals all available for you, okay? So basically, we have this old high, liquidity above. What's going to happen? I have my point of interest above. Price comes above, and then this is my candle on the lower time frame. Price closes above, then leaves a wick. And then another candle closes above, also with a wick. But I don't see that big momentum to the upside. I don't want to see this type of candle to the upside. I want to see small candles with bodies closing above. That's okay. I don't want to see this type of candle with a momentum. Whenever price comes back to the range, I don't want to see many candles, and I don't want to see a range in here. I don't want to see a range. I want to see a few candles. It's okay if they close above this level here, and then whenever price comes down into my original range, I want to see a change of character. So let's say I had a change of character here. Whenever this line is broken, I would look for a fair value gap, and it's gonna be our 2022 mentorship model. So whenever a candle closes above this level here, we need to wait for a change of character, a fair value gap, and we enter. Now, there are multiple entries here. What you can do is, my favorite one is fair value gap aligning with a breaker block. Okay, that's my favorite one. Most likely, if you have this type of pattern here, press come down. Now this was an order block, right? And it was broken. Now this is a breaker block. If there is this breaker block aligning here, and then there is a fair value gap aligning here, I would enter from here. Even if there is an extreme fair value gap all the way here or all the way here, price most likely will react from here and go down. It's not gonna go all the way here. So this is something to keep in mind, okay? So my first entry is a fair value gap with a breaker block. Second entry is fair value gap by itself. I'll take it. And then you can also go with order block. But I really suggest focusing on this fair value gap and breaker block, especially with this pattern. Now the time frames that we're going to focus on are when we have a swing. So for our swing and for our high probability point of interest, we need to use the 4-hour, okay? Especially for the swings. For the point of interest, you can use the 4-hour, you can use the weekly too, and the daily. Those are really high probability point of interest. When you have a fair value gap on the weekly, and you have this type of thing, so let's say you have a weekly fair value gap here, and prices coming, a lot of time it will react from here. So I really want you to focus on the weekly and the daily fair value gaps also, but also use the 4-hour fair value gaps, point of interest, and swings. So for the swings, we need to use the 4-hour. Okay, for the swings. Now for the candle formation that I just covered, we need to use the 30-minute. Okay. Now my old 4-hour sweep, we used to go with a 4-hour and 50 minutes, right? The reason that I'm going up a little bit to the 30 minutes, just to confirm that this is a valid liquidity sweep or no. That's the reason, okay? Now, this is for the candle formation, 30 minutes. After confirming the candle formation, what I can do is go to the 15 minutes. But if you want to take quicker and tighter entries, then you can go with the 5 minutes, okay? So that's for the entry. This would be so clear when I go to the last part of this video, which is putting it all together. Now talking about order flow and taking profit. This is very important point, and a lot of people lose trade just because they're not aware of this, okay? Let's assume price is doing this. That's what you see, okay? And that's what we always talk about. A point of interest here. What happened is price come down, sweeping liquidity, and then react from here. What do we target? What do we target? That's the main question, right? Now, sometimes you're gonna target this high, and sometimes you're gonna target this. And I get this question a lot, right? When do we target this, and when do we target some fair value gaps or those liquidity levels here? That's the main question. And the answer is order flow. Let's go to the left a little bit. Now, if price was doing this, right? The big picture is price going up. What you can get from this is when we have a sweep to the downside, price goes up. This is a valid liquidity sweep, and that's our strategy. We see it valid here. What we can target here is external liquidity. Why? Because we have valid breaker structure, right? So now we'd be expect another breaker structure to the upside. That's what we should target. If you target those internal liquidity here, you would miss part of the movements, which can be avoided by just taking a look at the big picture. If you are trading with the trend, with the order flow, then you can target the external liquidity. Now, in another case, let's say we have the same model that I'm explaining here, right? We have this point of interest, price come down, sweep liquidity into a point of interest, and then go up. That's our model, right? And I'll go over it when I put it all together. Now, what do I target? If I just switch to the left and show you the big picture, you would see price going this way, okay? And then maybe more to the upside. Price is going down, giving you multiple breakout structure to the downside and rebalancing fair value gap, rebalancing fair value gap. Now, what you can get from this is you don't expect a price to go all the way here. This doesn't align with the order flow that we're seeing, right? So what you can target, as I said, this model can be used with the trend and against the trend, both sides. But we need to know what to target in each situation. So in this situation, when I'm trading against the order flow, what I can target is not this, but I can target the internal liquidity and I can target point of interest. So I'd expect price to come here, you enter here, and then goes up from this fair value gap. There is a chance price will come down, so I can target this. This would be my target. But then there's also another chance that when I have a turtle soup here or a liquidity sweep here, I would expect price to go up, get some fuel from here. If there is a point of interest here, and then there's this swing, price can go and ignore this fair value gap, goes up, give an inducement here, more liquidity, engineered liquidity here, and price will go up to this fair value gap above. So you can target the internal liquidity here. Price will go up and started to go down. But if you are targeting the external liquidity, it will not work out. So as a rule of thumb, and just to set some rules for our trading plan, when I'm trading with the order flow, I'll target the external liquidity. When I'm trading against the order flow, I'll target the internal liquidity or any point of interest. Now, before getting into examples, I know some of you are still kind of confused, but everything will be cleared when I go over the examples. And maybe now I'll try just to put it all together for you. The plan, what is it? Basically, I would first start by marking my POIs the way that I taught you. So let's say I have a liquidity here and then my POI above. I would anticipate price to go and sweep this high now, going into the higher time frame POI, and then I'll expect price to sweep liquidity and then come down. So this is a turtle soup right here. I go here whenever the sweep happens. I would go to the 30 minutes and I'll zoom in. On the 30 minutes, if price closes above the level of liquidity, what I will do is I'll wait for a change of character and then I'll enter from a fair value gap. If price doesn't close above and only leaves wicks behind, then what I can do, and especially if it leaves a rejection block, right, with big wicks, in this case, what I will do is I'll wait for any change of character after, and I would enter without the need of change of character or market structure shift. And then I'll target the either the internal, external, or POIs. It's gonna be as easy as this, but it has a high win rate. It's always high probability liquidity sweep. You would love it. It's so mechanical. You can establish a checklist, and I wrote all the steps for you guys. But it's so easy. It's so mechanical. You have some mechanical rules. If this happen, I'll do this. If this happen, I'll do this, and then I'd always know where to target. I would always know how to mark POIs. It's all mechanical for you. Okay, starting with the first example. This is really an example that I took myself. I'll try to cover the examples that I took myself first, and then if there are some extra examples hand side, then I'll cover them too, just to learn. So basically, if I start with the order flow, I can clearly see it's bullish, right? A lot of break structure to the upside, and even if I zoom out more, you would see this big lick. I'm on the 4 hours, so you can see clearly that I'm being bullish, right? Now, this determines the take profit. So now I know my take profit is going to be point of interest or internal liquidity. Now, what I'll do is I'll go and look for my high probability point of interest. What I can see here is, oh, I see those relative equal lows here. I'll mark them, and I'll see that there is this fair value gap that's not filled, right? A clear fair value gap. And then there's also another fair value gap below. So I can take it from here to the other fair value gap. So I have this. So maybe price will come down here into this zone here, and they'll start to go up. What I can target is this internal liquidity, right? This is an internal liquidity. And similarly, I can see the same here. I have this liquidity and I have this fair value gap that's not even filled to the 50%. I'm gonna decide if price comes down here, I would buy. If it comes here, I would sell. Now, if I sell here, I would only take profit at somewhere in here, maybe a point of interest, or I would expect price to go all the way here and then keeps going up, right? Now, what's gonna happen is I'm gonna play, but I can see that price is approaching this. So now I'll ignore this. Maybe this is gonna be, if I enter here, this is gonna be one of my targets. I'll target a point of interest here from my first take profit, and then the last take profit is gonna be this potential turtle soup. Now, if I switch to the 30 minutes, that's the time frame that we look for the formation of our candles. And even in the 30 minutes, what you can see is price only filled this last fair value gap, which is the accumulation zone. When you have two fair value gaps, first one here, second one here, price will come, it will create some liquidity on this first fair value gap. Maybe it's gonna go up a little bit, but then after that, it's gonna go down into the second fair value gap, a turtle soup, and it's gonna go up. So this is all accumulation, this is manipulation, and then distribution starts here. It's the same here. Price is only filling the first fair value gap, and this is confirming our higher time frame bias, right? Or our higher time frame indications that price is gonna go above this. I'll wait and I'll see what happened. Okay, I see now. Now this is my 30-minute candle. I can see the closure of my candle exactly. It doesn't close above. It leaves a wick, and then it closes below the line. This is our high probability liquidity sweep or turtle soup. That's what we want to see. If the second candle comes and close with a smaller wick, same body, and then it started to go down, this is my rejection block. So let's see the next candle. Okay, now this is my rejection block. So most likely price will not go above this point. So it's safe to put your stop loss above here. It's safe. Most likely price or this rejection block will hold. Okay. So now after this, when I see this candle formation, what I can do is go to the 15 minutes and wait for any fair value gap. I see no fair value gap here. No fair value gap. No fair value gap. Nothing so far. And you see how price is getting rejected from this zone. You see, one more time. Now there is a potential of a fair value gap here. And there is a fair value gap. So there is this fair value gap here. There's also another potential for a fair value gap here. But as I said, when you have two fair value gaps, if there was a fair value gap here, let's say, this is gonna be my accumulation. and manipulation would be inside this fair value gap and it start to go down for distribution. So it's really not a good movement to enter from here. That's only if this is a fair value gap. Okay, so we don't know yet. Now, this is a fair value gap, but I would not enter from here. I would enter from here, maybe at the beginning, or maybe with this mitigation block here. So I can enter from here, right? So I'd have my sell limit here, stop loss all the way above, and I would go and target on the 4 hour. If I go to the 4 hour, what I can see here, I can target this point of interest here, right? And I also can target this low and those relative lows for a turtle soup, but this is kind of risky. Why? Because price can go above again and then come down for this turtle soup. So we cannot expect the time of this turtle soup. What I will do is I'll target this area here, this extreme fair value gap, right? So all the way here, and that's 3.8. If I go to the 15 minutes again, so we get filled here, we get filled, and then let me switch to the 30 minutes just to save up some time. And yeah, it goes to the take profit. Now going over this example, I would see price is kind of ranging. So overall, we're bullish, but then price started to go down here, then up, and it's ranging now. We are in a bearish movement, so it's nice to go short now. We can either target external or some internal. Okay, so let's see. Price created some liquidity here. Why? Because we have this order block here, and price does fill this order block here. But you can see if price started to go down, we can just leave it. But I did expect price to go above this point. Why? To take some fuel before going down. And if you can see, this is what happened. Price needed to go deeply more inside the order block. Now, if I switch to the 30-minute, or I can just replay this just to see what's happening. I'll go to the 30 minutes, which is our candle formation time frame. Then go above. This is my liquidity, right? This is my liquidity now. If you can see that price doesn't close above this point. See how we're getting a big rejection from here? That's what we wanted to see, because I'll just wait for the next candle to confirm this. Now it's confirmed. The second candle doesn't have that candle to create a rejection block, but this is still a very nice liquidity sweep. What I'll do now is go to the 15 minutes, and I would look for a fair value gap. No need for a change of character in this case, right? If I play, I see no fair value gap yet. Now there is a small fair value gap here. I can immediately enter from this fair value gap. This one right here. I can enter from the beginning of the fair value gap. And sometimes you need to be good with 3 or 4 to 1. Okay. Now, what can I target here? I can definitely go to the 4 hour and I can target some long-term take profit. But for now, I think it would be nice to go maybe all the way here or target this fair value gap here. If I switch to the 30 minutes, there is a potential of price sweeping this low here into this fair value gap. So I would go into this fair value gap here, and that's 3.5. But then for long-term take profits, if you want to hold the trade more, then you can target the external, which is all the way here, somewhere in here. So you can target the external, but this is 27 hours, so I don't want to take that big trades, right? Because there's a potential that price can go, and since you have a small stop loss, so no need to risk your 1% for this type of trades, right? So what I can expect now is price going into this fair value gap and going all the way down, maybe giving another sweep here, and we get filled now. We get filled, price goes up. I'll switch to the 1 hour just to save up some time. Um, so we get filled one more time and then price go down. You see how it should be nice with taking profits? You see where I take profit, price only sweep that point. So you really get profit and then you're taken out before this is all happening. So you should know where to take your profit. And then there was a clear order block here that was not filled. So what you could expect is price to fill this order block and sweep this low. That's what happened. So you should be out of the trade, or you should take some profits here and then have your trade on break even, and you should be, let's see if it keeps going down. Okay, it keeps going down, but then it goes up. So you should be kind of stopped out here with some profits. Now, price, if I switch back to the 4 hour, I can see another sweep. You see how price started to lose some momentum right here and then started to go up to take more fuel. So we can also go with another trade here. Now, the sweep happens here, and this is a trade that I took myself. It's this one, not this one. Just because I was not available at this time. This is the time that I trade here. Okay. Now, switching back to the 30 minutes, we want to see a change of character, right? And a change of character would be all the way, I'll take it here. So change of character all the way here, but this is too far. So maybe I'm either expecting price to go down and then go in above and then give me that change of character with fair value gap with breaker block, and I'll sell from here. Or there's also another scenario that price will come down, fill a fair value gap, and goes up and then go below this point. If it goes below this point, I can sell from here. And let's see what happened. I'll go back to the 15 minutes. So I do have a fair value gap here and a fair value gap here. I don't see any valid point to take some change of character. Even those points, I don't see them as a valid pullback. Price come down, price fill this fair value gap. What I want to see is a small pullback and then going below this point. This I would consider change of character. Now this is a valid pullback and price closing below this point. So whenever price close below this point, I'll take this as a change of character. Now let me wait for the next candle. Now I do have a confirmed fair value gap. This is a fair value gap, so I can enter here. I would go and have my sell limit at the beginning of the fair value gap, or maybe somewhere in here. Stop loss all the way above. And what I can target is, maybe I'll go to the 30 minutes. Okay, and I can target maybe all the way here. Or if I go to the 4 hour, let's say, can I see here is this fair value gap here. If you're bearish and your order flow is bearish, you can either take the external here or go with this fair value gap, right? And then there is also another turtle soup potential entry. See this liquidity building here? We have a fair value gap here and a fair value gap here. So there's a potential price will come down here, give us an entry. So we can also target this point right here. But I will be good with, let's go not 6-1. I would be good with this external liquidity 4-1. But you can still target this or this. But I'm trying to convince myself that I'm good with 4-1, 5-1, 3-1. I'm really training myself to do this. So basically, let's see if we get filled here. 15 minutes again. We have this fair value gap. And we get filled here. It goes all the way to the order block or the beginning of the fair value gap and started to go down immediately. And I don't know where it's gonna go to, but I remember it was sinking so bad, right? Now we had this fair value gap here, so maybe there's a potential of price going all the way there. Now price goes, okay, so it goes to the extreme fair value gap here, and it keeps going down. So this is another example using this method. The first example was without a change of character, and this example was with a change of character. You could secure a lot of profits here, like 2020R, but that's not how I do it. To finish it up, and after you watch this video and you got this far, what you need to do now is rewatch the video. If you still have some doubts, rewatch the video once, twice, and then start to apply everything you learned today into the chart. Try to forward test and back test. Always try to convince yourself to stick to the plan and have your psychology on point. And then after that, there's nothing that's going to stop you from making profits. There's also one thing. So what we use is the 4 hour and then 30 minutes and 15 minutes for the entry, right? Now, there are some people who want to scalp and can't use those time frames. Those are the time frames that I found work the best when it comes to this trading plan. But what you can do is you can use some other time frames, but make sure they're aligning with each other. You can try and find what works best. For example, you can use the 1 hour and maybe 15 minutes for the candle, and then 5 minutes or 3 minutes for the entry. You can do this. You can try and find what's working better with each pair, but those are my favorite time frames. Those are the ones that I found this trading plan works the best. I really wish you the best. If you Now, one more thing, guys, if you guys want to have access to the trading plan PDF that I put it together, it took me hours to put it together this way. It has a lot of details. You really need to see this. It's free. Just make sure you join the Discord on the description, and after that you go to the Mulham education here on the community corner. That's all. If you guys like the video, then do not forget to support me, subscribe to the channel, leave a like, and share the video to the people who think they need this training plan. And that's it. I'll see you in the next video.